Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I just wanted to do a really quick market update for you for the week. And I'm going to share my screen here and jump right in to where we are so that we can get you out of here. Okay, so I'm not going to run through this entire article. If you get our newsletter, you'll see this in there, or if you are on our social media page on Facebook, you can get this there also, or reach out and ask us for it. We get this every week from MBS Highway, Barry Habib's. Again, Sue, we're usually going to follow because he's typically right, unless something comes out of left field that's unexpected. But here are the Cromford market update numbers. I'm going to go through that in a minute too. But what the media gets wrong about home prices. Now, the home prices in our area, according to Cromford report, has been going up, as far as the average price monthly sales. So we see that, we're seeing our pricing going back up again, which makes sense just from the standpoint of the fact that we are in the busy season for us. Typically April last week was always the biggest week across the country for home sales. Typically, that's the week where we see the most activity happening. So April, early summer, for us here in Arizona, since school lets out in May, is usually when things really pick up because people want to try and move before, school's back in and the activity year's back in August for us, or, in some places around the country by September, right after Labor Day. So, that makes sense from that standpoint. Also, remember, we hit the bottom of the market around December. Okay. So since then, we started with a little rocky start at the beginning of the year because rates were still pretty high. But, we have been seeing an uptick in activity and prices and properties going under contract. We still have very low inventory. I checked it this morning. We're still right at about 12,000 homes for sale, a little over 12,000 homes for sale. That's all property types in our MLS, in our multiple listing service, where we list homes for sale. So again, typical, normal market, a average market or neutral market, if you will, for us would be more around 4 to 6 months supply, or it's a balanced market. And for us right now, we know that we're in, if you look down here at the bottom of this chart, we're at 144. And this chart for the Cromford Market Index has been steadily going up since December. Okay. So we know that things are definitely picking up for people who are waiting to see what's going to happen and worried about a recession. I get it, but you need to get kind of real with what's going on with at least our local market here, and really in most places across the country right now, because rates, again, we're over 7. A lot of times on the news, you'll hear them stating that they're around, low sixes, low to mid sixes over the past couple of weeks. And we've actually had people, with conventional loans just in the past week or two that were, getting their rates without any, 2-1 or 3-2-1 buy downs. They were in like the mid to high 5s. So guys, this means that, you can get the good price now, like I've been saying for several months, and then refinance later. Are we going to see a drop in rates again? Well, year over year inflation should drop even more by May 10th, as we've been saying, because that's when we see some more of the Fed announcements coming out. And in June, July, we should see, third and fourth quarter, that year over year inflation, because shelter costs, on things like rents and stuff have gone down so much. From where they were, along with sales prices. So that makes them about 43% of that total inflation number that they're usually looking at. Okay. Now there's things in there too, like energy costs and stuff, which make up about another 9%. That's been part of the problem too, because our energy costs have been so much more the last 2 or 3 years. So, so anyway, this that'll start catching up, and it takes several months to catch up because of how, you sign a lease and that lease isn't over for 12 or 24 months, and that sort of thing. And, some of this other stuff takes time to catch up. So, and the Fed's always looking in the rearview mirror. So as the year-over-year inflation drops, we're going to see rates drop even more than they already have. But that means, and because we're in a busy season, we're going to see, like we are right now, prices go up. And technically, again, we're at 144, so we're in a seller's market technically. So we're seeing multiple offers right now, and those sorts of things again. In the lower price points, we've seen as many as 20, 25 offers on a property, and the higher price points are mid to higher. We may see, three or five offers going right now, or maybe a little bit more depending on how nice of a property it is. So guys, I would definitely get off the fence. Every indicator of what's going under contract, still low inventory, numbers of contracts are going up, all that kind of stuff is going up. So I would say, every indicator shows us that, when the media talks about prices and stuff, they're wrong, at least in our market. Home builders need to be starting something. This goes into the idea that, home builders slowed down. Okay, they want to see what was going to happen with the market, but they need to kind of, gear things back up. And that's what they've been starting to do again with more permits, slowly but surely. They just don't want to get caught off guard like they did in 2008, where they had over inventory. Then they had the poor lending practices, which led to the crash. Okay, that's kind of how that all went. And, with over inventory, we get into that issue, which we do not have right now. So that's kind of been keeping, the market stable. It's also, another reason why we're seeing all these multiple offers, because just got to get more properties out there, people to buy. Plus, if someone's selling a property and buying a property, it kind of cancels each other out because it's not new inventory, where with builders, that's new inventory. Just a quick summary here on, reports cautious optimism among home builders. So they've been optimistic in all the reports, and they're getting things going. So job market, the reason why we always talk about the job market getting weaker is because the Fed finally caught up with trying to tame inflation. Well, we see that our GDP is just over, like 1.1%. The jobs market has been getting weaker when you look at the real numbers, after we got through some of the stuff that was lumped in at the beginning of the year. And there are a lot of layoffs happening in a lot of places. And everybody who kind of left from the COVID thing is back now. So what does that mean? Well, the reason why we talk about that is, when they're doing their demand destruction or trying to tame inflation by raising the Fed's fund rate, that slows down production for companies. It slows down acquisitions. It slows down hiring. We're seeing people getting their hours cut, which is also another indicator overall. So when we look at all these data points, we see that, whether you agree with how the Fed does things and if they should even exist and all that, Federal Reserve, criticize them a lot, but that part is working, and I think they've overdone it at this point with 1.1 GDP growth. I think that's really an end all, and I mean even things like how much cardboard is being produced and things like that has been way down. These are just a whole bunch of indicators that is showing that the economy needs to wake back up again, and they need to kind of take the foot off the pedal. So we'll see what happens with the Fed's fund rate, but do not confuse that with mortgage rates. When you hear the Fed raises Fed funds rate by da 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 da, well, it's not the same as a mortgage rate. It does affect it indirectly, but not directly. Now, a recession, it says recession signal flashing. Well, actually, housing does very well. I've shown these charts many times in the past. I should have pulled one up for you, but you can see, except during the actual housing crash, which caused that particular recession, housing always does well. Interest rates always drop. Interest rate drops one whole interest point. That brings about 5 million more people into the market that can now afford to buy. And so, usually your equity and your housing and stuff does really well during recessions, unless it's a housing market recession, which we're not in. We're not headed towards. There's no indicator of that. We're not even seeing, any issues with foreclosures and things like that. So from that standpoint, again, especially in our market here in Phoenix, we've got a strong jobs market. We've got the indicator of prices going up and, these multiple offer situations happening. So, guys, I wanted to just mention a couple other things. There's been a lot of talk in the news, and I'm not a loan officer, but we've got some loan officers you could talk to about these things. But, we've had things in the media kind of talking about how, they've made some changes to, if you got good credit, you're going to pay more, for the people who have bad credit and all that. Well, first of all that stuff has already been baked in since the beginning of the year, basically. It's nothing to get too alarmed about. It sounds, like it's, unfair situation and stuff like that. And quite frankly, it's just another way to kind of offset some of the issues we've had in getting the housing market going because of inflation, interest rates, with what Fannie and Freddie Mae are doing. So I would say talk to a loan officer a little bit more about that situation. But, you're really not going to notice it either way. Okay. So anyway, there's also been a new some new buzz out there about a 1% down. There's down payment assistance programs, all kinds of down payment assistance programs. Usually people are going to put on an FHA loan a minimum of 3.5% down. With conventional, you typically see a 3% or 5% down typically on conventional loans. But for FHA and conventional, there's down payment assistance. You just usually pay higher fees with that. And then of course, VA, there's no down payment requirement there for our veterans. But there's this 1% conventional program that's out there. And that's based on income in your area and stuff like that. So again, without getting into the weeds of that, that's a new thing that is out there, 1% conventional. You talk to one of our loan officers or somebody you trust about that in more detail. They could certainly talk you in, figure out what works best for you. So guys, that's all I have for you this week. Nothing, crazy, except I would say buy, sell and buy, or buy sooner rather than later. Because as those interest rates continue to drop, along with the year-over-year inflation, not that there's no inflation, but it's dropping. We're going to, it's just an automatic effect. We're going to see rates come down. And then even with a recession in the economy due to other factors, we're going to see the housing market does really well. We're going to see more people come in to buy homes. We're going to see more competition. So it's better to buy now while you can maybe be more competitive and get that better price on a home. Go a couple months without even having a mortgage payment until that first payment comes up. And then you can always refinance later. You can refinance, 6 months from now, a year from now, whatever. So if you have any questions at all, it's 480-788-8569, or you can check us out at MincolaHomes.com, MincolaGroup.com, or email us at home@MincolaGroup.com, and check us out at Facebook, Instagram, and YouTube. We'll talk to you guys next time.